Trading and Market Risk Interview Preparation Guide for Risk Teams. If you are preparing for market risk or trading risk roles in banks, investment banks, or global trading firms, this video is built exactly for you. We have created very comprehensive interview preparation material, specially designed for market risk teams that support trading desks, not textbook definitions. In this session, we go deep into how market risk actually works on a live trading floor, from VaR and stressed VaR to expected shortfall, Greeks, stress testing, limit breaches, model risk, and risk escalation. You will learn how interviewers expect you to explain risk numbers, P&L drivers, portfolio behavior during stress, and interactions between market risk, credit risk, and liquidity risk, clearly and confidently. Do watch this video till the end. This level of preparation genuinely separates strong market risk candidates from average ones. Explain the primary responsibilities of a market risk analyst within a trading organization. A market risk analyst protects the firm from losses caused by adverse market movements. Your responsibilities include monitoring daily exposures, reviewing risk sensitivities, validating P&L drivers, and checking compliance with trading limits. You analyze VaR, stress tests, and scenario results. You challenge traders when assumptions seem aggressive. You escalate breaches quickly and provide clear commentary to management. Your role is independent, objective, and focused on preventing unexpected losses. Describe the difference between market risk, credit risk, and liquidity risk. Market risk measures losses from price movements, equity prices, interest rates, FX rates, commodity prices, and volatility. Credit risk measures losses when a counterparty fails to perform, for example, default or downgrade. Liquidity risk measures losses when markets become illiquid, meaning you cannot buy or sell positions without moving the price significantly. All three interact, but each requires different tools, analytics, and monitoring. Explain how value at risk, VaR, is calculated and the differences between historical, Monte Carlo, and parametric VaR. VaR estimates the maximum expected loss over a time horizon, usually 1 day, at a confidence level such as 99%. Historical VaR uses real past market movements. You revalue the portfolio using each day's historical shock and take the loss at the chosen percentile. Monte Carlo VaR simulates thousands of future scenarios using statistical models, useful for non-linear portfolios. Parametric VaR assumes returns follow a distribution, often normal, and calculates VaR using variance and covariance. Each method has strengths. Historical is intuitive. Monte Carlo is flexible. Parametric is fast, but can underestimate tail events. A sudden spike occurs in daily VaR. Walk me through how you investigate the cause. Start with the portfolio. Did risk sensitivities change significantly overnight? Next, look at market data. Were there large shocks in rates, FX, equities, or credit spreads? Then, check for model changes, new curves, volatility surfaces, new correlation updates. If none of these explain the spike, compare today's portfolio to yesterday's. Did a big trade book mature or unwind? Finally, validate the VaR engine itself. Errors in data feeds or time series updates can cause artificial spikes. Explain the concept of stress testing and scenario analysis and why they are essential for market risk. Stress testing asks, what if extreme events happened again? Scenario analysis recreates historical events, the global financial crisis, COVID shock, Eurozone crisis. It may also build hypothetical scenarios, a 50 basis point rate jump, a 20% equity fall, or a commodity shock. Stress tests reveal vulnerabilities that VaR cannot capture. Regulators require them because real crises rarely follow statistical models. Describe how risk sensitivities, delta, gamma, Vega, rho, CS01, DV01, are used to understand portfolio exposures. Sensitivities translate complex portfolios into easy-to-understand measures. Delta, sensitivity to underlying price. Gamma, change in delta when price moves. Vega, sensitivity to implied volatility. Rho, sensitivity to interest rates. DV01, sensitivity to 1 basis point rate change for fixed income. CS01, sensitivity to 1 basis point change in credit spreads. Together, they form a map of P&L risk drivers. How do you evaluate the risk of an options portfolio using Greeks? Start with delta to understand directional exposure. Then review gamma. High gamma means P&L can swing quickly when markets move. Next, analyze Vega. Option portfolios with long maturity or at-the-money strikes often have high Vega. Check theta, the time decay effect. Traders may gain from theta or lose from it depending on structure. Finally, consider cross effects, delta-gamma interaction, and correlation dependencies. A Greek-based view simplifies complex nonlinear exposure. A risk limit breach occurs on a trading desk. What immediate actions do you take? First, confirm the breach. Ensure data is correct and up to date. Next, notify the trader and desk head immediately. Simultaneously, escalate to market risk management. Identify the cause: new trade, market move, or model change. Then require action. Hedge part of the exposure, reduce positions, or temporarily halt new trades. Document everything, including follow-up analysis and remediation. Explain Incremental Risk Charge, IRC, and how it complements VaR. Incremental Risk Charge, IRC, measures risk from default and migration events in trading book credit positions. While VaR focuses on short-term market movements, IRC captures longer-term credit risk, specifically for bonds and credit-sensitive instruments held in trading books. It complements VaR by addressing tail events that involve credit deterioration. Describe stressed VaR, SVaR, and why regulators require it. Stressed VaR uses the same VaR methodology but applies market data from a period of extreme stress. For example, the 2008 crisis. Regulators require SVaR because normal VaR may underestimate risk during quiet markets. SVaR ensures banks hold capital for times when markets behave violently. How do you challenge front office assumptions used in pricing or risk methodologies? Start by understanding the assumption clearly: curve inputs, vol levels, correlation settings, or model choices. Next, compare these assumptions with independent market data. For example, compare trader-implied volatility with broker quotes. Then, benchmark against alternative models or peer practices. If assumptions seem optimistic, you challenge them politely. Request justification. And escalate if needed. Market risk must stay independent. Explain how interest rate curve shifts affect the P&L and risk profile of fixed income portfolios. Interest rate curves represent borrowing costs across maturities. If the curve shifts up by 10 basis points, the value of fixed-rate bonds falls because future cash flows are discounted at higher rates. If the curve steepens or flattens, assets with different maturities respond differently. P&L impact depends on DV01, convexity, and curve risk exposures. Understanding curve shapes is essential for rate portfolios. A large unexplained P&L movement occurs. How do you analyze and validate its cause? Start with a risk-based P&L explain. Delta times price move, Vega times vol move, DV01 times curve move. Check if these explain the reported P&L. If not, investigate structural reasons: misbookings, incorrect market data, missing trades, model changes, incorrect sensitivities, system issues. If still unclear, escalate quickly. Unexplained P&L is a serious control issue. Describe how liquidity risk impacts market risk management. Liquidity risk affects how quickly positions can be sold. During stressed markets, bid-ask spreads widen, volumes dry up, and market impact increases. This amplifies market risk because models may assume tighter spreads. VaR and stress tests often underestimate losses when liquidity evaporates. Liquidity-adjusted metrics, such as long closeout periods, help capture this risk. Explain basis risk and provide an example of how it arises in trading books. Basis risk occurs when two related instruments do not move perfectly together. Example: a trader hedges a corporate bond with a credit index. If the bond spread widens, but the index spread moves less, the hedge underperforms. The difference is basis risk. It appears across rates, FX, commodities, and credit markets. How do you measure and monitor concentration risks within a trading portfolio? Concentration risk builds when exposures cluster. You measure by grouping positions by asset class, currency, sector, issuer, country, rating bucket. Compare exposures with internal risk appetite and regulatory expectations. High concentrations require extra limits, hedges, or diversification strategies. Explain how correlation affects multi-asset derivatives and overall portfolio risk. Correlation determines how assets move together. High correlation means shocks propagate quickly across instruments. Low or negative correlation can reduce risk through diversification. For multi-asset derivatives, baskets, options on indices, correlation swaps, P&L depends heavily on correlation levels. Small shifts in correlation can produce large changes in valuation. Describe how stress scenarios are designed, calibrated, and validated. Design begins with identifying plausible but severe events: rate shocks, FX devaluations, equity crashes, commodity spikes. Calibration uses historical stress periods or hypothetical assumptions. Data must reflect realistic magnitudes. Validation checks weather scenarios. Capture portfolio vulnerabilities. Match regulatory expectations. Align with macroeconomic logic. Are severe enough without being unrealistic. Scenarios must evolve with market conditions. Explain expected shortfall, ES, and how it improves upon VaR. Expected shortfall, ES, measures the average loss beyond VaR at a given confidence level. If VaR identifies the 99th percentile loss, ES measures the average loss in the worst 1% of cases. ES captures tail risk more effectively. It avoids VaR's blind spot, ignoring losses beyond the threshold. Regulators prefer ES for its superior risk sensitivity. How do you validate and challenge market data inputs such as vol surfaces, credit curves, or FX forwards? You start with source comparison: Bloomberg, Reuters, broker quotes. Check for outliers, stale data, or inconsistencies across tenors or maturities. Validate smoothness. Vol surfaces should not have unrealistic jumps. Backtest data using historical behavior. If the inputs seem too optimistic or too pessimistic, challenge the desk. Data quality directly impacts P&L and risk, so it must be checked daily. Describe wrong way risk, WWR, and how it interacts with market movements. Wrong way risk occurs when your exposure to a counterparty increases at the same time the counterparty's credit quality deteriorates. Example: a bank enters a commodity swap with a small oil producer. If oil prices collapse, the bank's exposure rises because the swap becomes in the money. But the producer's creditworthiness also weakens because low oil prices cut revenue. So exposure rises. And credit strength falls at the same time. This is the wrong way. Market risk and credit risk reinforce each other, creating higher expected losses. Explain how market risk teams work with product control to reconcile risk-based P&L. Explain. Product control explains P&L using accounting and booking logic. Market risk explains P&L using risk sensitivities: delta, gamma, Vega, DV01, CS01, and so on. Both teams meet daily to compare actual P&L, risk-based P&L, residual or unexplained movements. If numbers don't align, you investigate. Incorrect Greeks, wrong market data, missing trades, booking errors, model changes. The goal is simple. Each day's P&L must be fully explained with clean risk drivers. A new instrument is proposed for trading. What steps do you take to assess its market risk? Start by understanding the payoff: linear, nonlinear, path-dependent, or exotic. Next, identify key risk factors: equity levels, FX moves, interest rates, volatility, correlation, or credit spreads. Then ask how the instrument is valued. Does it require Monte Carlo? Does the current system support this model? Do we need new market data feeds? Finally, define limits, hedging guidelines, and stress scenarios before approving it. No trade should go live without clear risk frameworks. Describe how counterparty exposure changes with market movements for derivatives. Derivative exposure is dynamic. If markets move in your favor, exposure increases because the replacement cost rises. If markets move against you, exposure decreases because the contract becomes out of the money. Volatility also matters. Higher volatility increases potential future exposure. This is why credit risk and market risk are tightly linked for derivative books. How do you interpret risk reports for senior management and simplify complex exposures? Senior leaders want clarity, not equations. You summarize the portfolio using key risk sensitivities, largest limit utilizations, major drivers of VaR, stress test outcomes, concentration risks, emerging issues. You highlight trends: rising rates risk, growing credit spread exposure, or volatility clusters. Use short sentences, simple charts, and clear takeaways. Your goal is to translate complexity into confident decision-making. Explain the impact of volatility spikes on equity, FX, and rates portfolios. Volatility spikes increase the value of options because higher volatility raises expected payoff dispersion. For equity options, Vega exposure drives P&L swings. Long vol positions gain, short vol positions lose. For FX options, both volatility and correlation shifts matter. Cross-currency options can move sharply. For rates portfolios, rate vol spikes affect swaptions, caps, floors. And exotic rate products, volatility shocks often dominate P&L on nonlinear books. Describe backtesting of VaR models and how exceptions are evaluated. Backtesting compares actual daily P&L to the VaR estimate. If the actual loss exceeds VaR, that day is an exception. You review: was the market unusually volatile? Was exposure larger than expected? Did a model input fail? Was data incorrect? Regulators set thresholds for acceptable exception counts. Too many exceptions indicate the model is underestimating risk. A trader disputes the sensitivity numbers you report. How do you verify accuracy? First, regenerate sensitivities using independent risk systems. Check whether the front office and risk systems use the same trade data. Next, validate market data: curves, vols, FX forwards. Incorrect inputs create wrong Greeks. Then, reprice the trade manually using a bump and revalue method. If delta equals P&L change divided by price bump, your number is correct. If discrepancies remain, escalate to model validation or IT. Explain how cross-gamma and vanna vomma risks affect exotic derivatives. Cross-gamma measures how exposure to one asset changes as another asset moves. For multi-asset options, cross-gamma can create large non-linear P&L swings. Vanna measures sensitivity of delta to volatility. Vomma measures sensitivity of Vega to volatility. Exotic products, barriers, cliquets, autocallables often have high vanna and vomma. This means small vol moves can cause disproportionate P&L changes. Understanding these second-order risks is essential for exotic desk monitoring. How do you assess model risk and its impact on market risk reporting? Start by identifying where models drive valuations. Exotic options, callable bonds, long-dated swaps. Assess model assumptions, calibration quality, limitations in capturing market reality, sensitivity to parameters, availability of independent benchmarks. Large model uncertainty requires reserves or conservative limits. Model risk is part of market risk, not separate from it. Explain how market shocks propagate differently across asset classes. Shocks rarely stay isolated. Rate hikes may cause equity sell-offs as discount rates rise. Currency depreciation may raise inflation, affecting rates and bonds. Credit spreads may widen during equity volatility spikes. Each asset class responds based on its economic drivers. Understanding propagation helps anticipate multi-asset risk events. Describe how macroeconomic events, rate hikes, geopolitical tensions, inflation shocks affect market risk. Rate hikes increase rate volatility and reduce bond prices. They also influence FX markets as yield differentials shift. Geopolitical events create risk-off behavior. Equities fall, safe haven assets rise. Volatility spikes. Inflation shocks weaken long-duration assets and triggers central bank interventions. Macroeconomic events reshape the entire risk landscape. Quickly and often violently. How do you escalate repeated limit breaches or structural issues in the risk framework? Document each breach clearly: size, duration, cause, and trader response. If breaches repeat, escalate to desk head, chief risk officer, risk committees, compliance. Recommend structural fixes, tighter limits, improved models, or revised hedging policies. Escalation must be timely and well documented. Repeated breaches indicate deeper control failures. Explain risk-weighted assets, RWA, for trading books, and how they are computed under regulatory rules. Risk-weighted assets reflect how much capital a bank must hold for trading positions. RWA depends on market risk, VaR, stressed VaR, incremental risk charge, default risk, issuer and counterparty credit risk, model approval status, regulatory multipliers, higher volatility, higher credit risk, or weaker models all increase RWA. RWA links trading risk directly to required capital. Describe how intraday risk monitoring works for volatile trading desks. Intraday monitoring tracks exposures continuously, especially on fast-moving desks like FX, equities, and commodities. You check intraday Greeks, intraday P&L, limit utilization, real-time market data, new trades and unwinds, margin calls. If exposures spike, you alert the desk and management immediately. Intraday controls prevent losses from snowballing within hours. A pricing model change results in different risk sensitivities. How do you validate and approve this? Start with a side-by-side comparison of old and new sensitivities. Do differences make economic sense? Next, run benchmark trades through both models. Check deltas, vegas, and curvature terms. Then consult model validation. They confirm theoretical correctness and calibration accuracy. Finally, Run P&L explains under both models, if changes are logical and documented. Approve the update. Explain the difference between front office risk, FO risk, and independent market risk. Front office risk reflects the desk's internal view. It uses front office models, trader assumptions, and may focus on hedging and P&L impact. Independent market risk uses separate models, independent data, and an unbiased perspective. Its role is oversight, not trading. Differences protect the firm from incorrect assumptions or excessive optimism. How do you challenge valuation adjustments, CVA, FVA, KVA, from a market risk standpoint? Start by understanding the assumptions: discount rates, spreads, collateral terms, recovery parameters. Check whether trader inputs reflect current markets. Compare spreads and curves with external sources. Run sensitivity tests. How does CVA change when spreads widen? How does FVA respond to funding cost shifts? If adjustments seem understated, escalate and recommend conservative values. A hedge is underperforming. Walk me through how you diagnose hedge effectiveness. First, compare hedge ratios. Did the trader hedge delta, DV01, or CS01 accurately? Next, evaluate basis risk. Hedge instrument and underlying may not move together. Check timing. Was the hedge adjusted too slowly during volatility? Review model assumptions. Differences in vol or curve settings can distort hedge P&L. Break down attribution to pinpoint the slippage source. Describe a scenario where you identified a significant market risk and how you communicated it to senior management. Here is a clean hypothetical scenario. You observe that the equity derivatives desk has accumulated large short vol positions ahead of a major central bank announcement. Vega exposure is high, and stress tests show large losses under a volatility spike. You escalate immediately with a concise summary. You recommend reducing exposure or adding hedges. Senior management appreciates early warnings that are clear, data-driven, and actionable. Market risk is not about predicting markets. It is about being prepared when markets move violently. This was a complete end-to-end interview preparation guide created specifically for trading and market risk roles supporting front office desks. If you followed this entire session, you now understand how market risk is measured, how limits are enforced, how stress scenarios expose weaknesses, and how risk teams protect the firm during volatility. Rewatch the VaR, stress testing, Greeks, and escalation questions. Practice explaining them calmly, because clarity under pressure is exactly what market risk interviewers test. For more deep, role-specific preparation across market risk, credit risk, product control, and banking risk careers, stay connected. And once again, do watch, revise, and master this material.